Right. Well, good evening. Not only is it another unmissable Sunday show, but it is episode 50 of Benny and the Squirrel. We made it, Ben. How are you?
Good. Yeah, episode 50. How about that? It's funny. It wasn't that long ago we were like, hey, we should do this, and we got excited about it, and now here we are, episode 50 in, and it's been a crazy market like along the way since we started.
Yeah. And no crazier than last week. We'll get to that in a second. So just a show note. I'm out of Australia for the next 3 weeks, coming to you live from Hong Kong. That's going to make some pretty early starts for me on the show. I think I've got a 4 a.m. kickoff with Larry on Thursday. But we'll look forward to that. Let's get to these markets, right? I'm gonna start with some seasonality.
Yeah, I think sometimes this is always a tricky part of the year because, as I like to say, I think I'm one of the best Q1 traders in the world these days, and this is no different again. It was a great Q1.
What I love is your humility, my friend.
I mean, I'm pretty fucking good in the Q1, and then after that, I'm highly mediocre. And and you look at this, and you're like, all right, we're here. It's May 10th. And people want to know what to do because it's like you said, when does this end? What will be the catalyst or what's going to unbreak this? But you look at, so I was like, all right, let's look at the COVID, because I do think that you really in markets have to think about things in terms of regimes, right? Bretton Woods 2, basically when China came into the fold in 94, the 2001 WTO, Euro, wasn't in, you can't really look at all of time as a consistent comparable. And so, I think it's worthwhile for the stock market. COVID was a big game-changing event. Well, May, June, July have been pretty ubiquitous greens time.
It's amazing. So much for sell in May and go away, right?
I mean, absolutely. It's really buy in April, and I don't have a rhyme for it, but sell in July, and that's kind of.
And you can't squeeze St. Ledger's Day into that. No, I think everyone likes to dunk on seasonality. Generally, I think it's just useful to be aware of it, right?
Yeah, I don't think it's something that you want to necessarily develop a trading strategy of. But I do think it's something where you can create a guardrail.
Which is precisely what we're going to do now. How are we going to trade the next 10 weeks, Ben?
Well, no, but I think about it like this. I'm thinking so much about AI systems a lot lately, and it's like these things are dumb. Me and you, the reason why we have a podcast that some people thankfully listen to is because we've been doing this for a long time. We've built up our memory and our context of why we see things, and we can just do it. And you looked at that window right there. Well, we're at S&P's up 8.5%. We're kind of where we were over, in 24, in 23, in 21, within a band. 25 we were down at this point, and then 20 was obviously, those were pretty. In 22 were pretty sharp corrections, but I'm just saying that. Where we are right now, when I read this Goldman, weekend note that I sent you from your former employer, gross exposure of hedge funds had been declining. Last week was the first week we saw an increase, right? So you're starting to see a market move from, hey, I want to get less short or I want to get less hedged to maybe I'm going to add some exposure. And what they're saying is that there's some offense being played all of a sudden, but it's weird because then you think about.
Well, they described it. To be fair, they described it as a stop in, right? People are just being forced into this market right now, right?
Well, that's kind of it, right? So that's what I'm trying to say is where we're at.
Which means I would contend that money can leave as fast as it came in, right?
Yeah, exactly. So I mean, if we go, you see the orange line, that's where we are. The 22 and the 20. And in last year, Liberation, we were down. We have 3 years up, and now we're here, kind of following the pattern that we saw in 20 that we saw in 23 after SVB, that we saw in 25 after Terra. So again, maybe that's why I'm overconfident in my Q1 skills, because it seems like all the, the action, if you're a macro guy, which if you listen to our show with Brent Donnelly last Thursday, he was like, look, I'm beginning my career, and this is how most macro guys are. I print money when there's vol. When there's not vol, you got to figure out what to do. And so we're in this window, which I've historically hated. And that's all I'm trying to say by this is like, here's the data. And there is the white line is the 30-year average. Like, so that's, stupid number because it gives you no ergodicity. It gives you no sequence. It just, here's the average of 30 years. That doesn't do anything for you. But in general, this is just not a great time to take bets on the negative historically, is basically what I'm trying to say. Like there are times when it works.
I'm going to take everyone through an idea which I sent to my subscribers last night around the semis, but we'll do that at the end of the show because I think there's a way you can play it.
So then, this was in that same note, and this is wild if you look at this. Like the dark blue line or purple, whatever you want to call it, is the calls, the volatility call skew percentile rank, where we're damn near at 100, and the put skew is basically at the 0, right? And you've seen it if you looked at the S&P or if you looked at the NASDAQ being up 25% since the end of March. So you saw it in the way you would look at markets, but this is kind of under the hood, if you will, the mechanics view, and that's extreme. Like that is a extreme move that we just saw happen, and they do happen sometimes, but like, man. And so, you look at this is the average stock. So we're not just the indice, right? We're looking at the average stock, and we were down, but now we're back up, and we were up with puts, and now we're back down at the basement. And, that's almost a 10-year look back window right there. Yeah. We're damn near at the bottom for puts, and we're damn near at the top for calls, right, Rupert?
Yep. Yeah.
And that's a 3-month, delta, 25 delta that this is measured on, just so people want to understand that.
Yeah.
And what you have to remember is that is a lot of people playing offense and doing no defense, basically, to use sports terms of what's going on here. And this is kind of one of the reasons why, right? I mean, why we've talked about it, and we'll talk about it in a little bit here, is this CapEx spend. We talked about it last week on the show where we said follow the money, and why, CapEx on an accounting basis flows right through to profits because there's a differential between revenues being recognized and, costs being capitalized. But you look at where we are here, and this is a Goldman note that got a lot of play last week, and they're talking about 24 times up in token consumption by the end of the decade. You look at that, you get kind of excited. Now, again, remember, linear thinking tends to be a thing that gets you charts like this, right? Like
what we humans are very good at.
We're the best at it. We're the best at cause and effect, and we stink at second order and higher order math. Like non-linearity stuff, we're just terrible. Which is kind of, just as an aside, one of the sources of value and alpha, or whatever you want to call it, like opportunity in markets, is taking advantage of linear extrapolation where there's second order effects on both sides too, right? Like this young guy, Leo Ashenborough or whatever his name is, that wrote the Situational Awareness. Guy took $100 million hedge fund. Now it's $5 billion. Like, he saw this 2 years ago and crushed, and so he saw the upside convexity to the right tail, and it's been extraordinary. Like one of those things you just don't see very often in life. But I just wanted to, here's the daily token queries, what they're talking about, linear lines, hilariously, and they at least try to curve it on the right one for the actual tokens. But remember, just as an aside, one of the things I'm working on is trying to teach people how to harness their prompts and their workflow better, because these systems are very much just one equation, a linear autoregression equation that optimizes, but how you harness it and you talk to it and you constrain it and you ask for output the way you would, way Rupert probably did to his juniors when he was a managing director working in Hong Kong back in the day. And that's actually like a huge amount of the value. So, it's hard to take early stage inefficiency and extrapolate inefficiency historically. Would you say that's fair, Rupert?
Absolutely. I mean, it's no different to any kind of approach to management, right? You don't say to a first-year associate, get me an M&A pitch together by Sunday night and expect it to be perfect when you walk in on Monday morning. You've got to manage each step. You've got to brief the agent properly. I totally get that, and I don't see why it should be any different, right?
Exactly. That's a great point. And we had humans doing that. We had, nice managing directors like Rupert and some non-nice managing directors out there that exist in the banking world being the editors and refining. And then you get to a point where the machine works smoothly. So right now, I don't think that you can look at these processes and extrapolate anything with any confidence, because also there's guys.
But then then you have to consider the wastage as well. I mean, if you think about the token wastage that's going on right now, because
it's insane.
Yeah,
and that's
so I think some of these assumptions around these right tails are based on continued inefficient usage of tokens, right?
Yeah.
And they just haven't built that thought and concept into the numbers, right? You just got a token max is the mantra right now, and that has to be bullshit.
Yeah, and I think the thing that you really get deeper into it is you realize that the reason why Nvidia's stock's not participating is GPUs aren't the constraint anymore like they were. And basically Rupert last 2 days ago or yesterday sent me, we talked I think last week, but I definitely tweeted about it or sent it to my subscribers. Like XAI decided to rent out their whole Colossus data center in Memphis, Tennessee to Anthropic. Okay. And then you see that, and then, okay, well, maybe they're bending the knee. Yes, probably bending the knee. And because of what Rupert and I talked about a month ago or so about the SpaceX IPO, they need to stop that cash burn. XAI ran out of cash.
Yeah, I just going to pause you there. I mean, I understand that puts some near-term free cash flow into SpaceX AI, right? But what kind of multiple do you want to put on a neocloud, right? Even if Musk is involved in running it, there's got to be a cap to the multiple that you can put on those cash flows. And ultimately, hasn't he just tapped out in terms of any kind of foundation model leadership? Right. Now, I hear the arguments that the Colossus 1 is really not optimized for training foundation models because it's a mixture of different types of GPUs. And actually, it's much more suited to Anthropic's inference workload now. But yeah, I think that's a tomato argument. At the end of the day, for the SpaceX AI IPO, Elon's sort of massive MacGuffin around the AI story behind SpaceX, he's just turned into a landlord, right?
Yeah, I mean, look, because you asked me what multiple do you put on a neocloud, right? And I said, okay, 5 to 8 times, maybe 10 if you like value the relationship with Nvidia, because that has some value, and you have the existing relationships with Microsoft. That takes time to build, so there's some value to that. But I just looked on Bloomberg, and CoreWeave is trading at 5.5 times 27, and it's trading at, I think, let me check one more time so I say this correctly, 11 times 26 EBITDA. So they're growing quickly, and so maybe that 11 times, but I think 5.5 seems more in the line of what we were thinking. An H100 probably has value for 8 years. It doesn't have as much value, like for training and for top of the stack inference. But still valuable. I think pretty much me and you would agree we'd like to have an H100 in the Benny and the Squirrel corporate balance sheet if we had one, that we could use. So it's not like some bum, I don't want to say Intel because That stock's ripping.
Don't fade Intel. Anyway, listen, you got a lot of slides in here. Let's skip through these quickly.
All right. Yeah, and so we've talked about this. We talked about last week. You're just seeing the CapEx become the new source of cash use, where we're going to 2 trillion in corporate cash. The S&P, this is the S&P 500, and buybacks and M&A are kind of buybacks flat.
Yeah, this comes back to the supply problem that the market, I think, has got coming into the summer, right? You've got reducing buybacks as the free cash flow gets diverted into capex. Listen, M&A, the whole sort of LBO flow, taking shares out of the market has slowed down. And then you've got all the supply from the IPOs if they happen. I think that's a dynamic that the US equity market hasn't had to live with for a long time.
Totally agree. I mean, I have nothing else to add to that. I totally agree. I think that if you want to be bearish equities, I think that these IPOs are kind of your thing. These are the numbers, which people who are subscribers, we send out the slide deck. You'll be able to see these, but the reality is taking CapEx from 1.3 trillion last year to 2.1 in 27 is a big jump, and share buybacks essentially flat. And then, like Rupert said, the denominator is growing quite a bit.
So much higher, right? What's the total cap done over the same period of time? This buyback lever is just so much less potent.
Well, because let's just do the numbers real quick. Okay, so they're going to do one.
No. Everyone, the numbers are sort of play school. That's easy, right? It's a much smaller lever, right?
Yeah, I'm just saying 3 IPOs are $4 trillion in cap, and they have 2 trillion in buybacks. So if you believe all those, and they get all the secondaries done, that's 2 trillion of extra paper in the market, basically.
Yeah, I agree. So listen, I thought this was an interesting slide here on the breadth, which you put together with your new AI tool. Why don't you walk people through this? Because it is extraordinary that we've got markets feeling as bubblicious as they feel, and yet 50% of the S&P by number is in a downtrend in technical terms.
I mean, it is kind of amazing because I get a lot of complaints from people that they're just like, wow, this is nuts. And, the slide right before this, just to show you real quick, this has been going around. The breadth is damn near the lows. So the whole post GFC concentrations at the high. But we even saw that on Friday. This is a dashboard I created, which has a whole bunch of things on it. It starts as should I be trading, and it has a score that's composites from a variety of different things. And I can send out the link to people who are paying subscribers on our Substacks to it. But you look on Friday, I mean, the technology, the XLK proxy, up 3.5% with breadth of 37. I mean, 9 of the 11 sectors had negative breadth. Materials was up just a little bit. You're just talking about a market that's getting narrower and narrower. And this is just a one-day snapshot of the larger trend chart that we just showed, right? And so it's a really difficult situation because I think you have 2 schools of thought. You have kind of our school, which is we'll sit in our hands and it is what it is, but it's easier to do that as guys who are absolute traders, macro traders, or newsletter writers or invest in your personal capital versus you're a mutual fund manager or a long short equity manager, which is basically a mutual fund manager because you're everyone's comparing you to the S&P and you're just losing ground every day, right? Yeah. Like you're in the wrong industrials, you're in the wrong spaces.
We're going to talk a little bit about how you could possibly participate in that in a second. But why don't you just finish on the on this rotation and the winners and the losers here? This is quite a tough slide to read. I think the next slide where you've got the histograms makes the story easier to see off the screen. But you go ahead on that.
Yeah, I mean, well, yeah, I see what you did here, Rupert. I'm going to go back real quick. I see our Ruber try to skip that one. The U.S. exceptional trade is another emerging
That
property.
wasn't deliberate. It was not deliberate.
Ruber tried to skip this one. But I sent this to a friend of the show, Brent Johnson, and he tweeted out, in which, he's got so many followers. I get my Twitter is full of notifications. But money's flowing into the Capex beneficiaries. It's flowing into the U.S. and it's flowing into Korea. And these are the groups. There was a guy from Nebius who created a website called AI Bottlenecks, which is very good. It's very similar to the one I created for my dashboard using Claude. And these are the groups, all these various groups are just absolutely and this is just the year to date, right? And everyone knows memory, but there's all these little areas that they were shitty businesses, basically, that now have a cash engine. Just they don't know what to do.
Yeah, so I saw a tweet yesterday. It was when I was flying up here on the plane, and someone was pitching a stock that I know really well from 20 years ago, which is ASE from Taiwan, the chip packaging and testing business, and saying, this is the next undiscovered story. And I was sort of curious enough to have a look at the chart. It's already doubled this far. It's already doubled year to date, right? This is not an undiscovered bottleneck, right?
Yeah, this is the easier way to read the last chart, because you have but INP and substrates, memory, as we know, damn near. Intel was on its deathbed, is back at the 2000 levels, trading like it's the 2000 Intel. So everyone's kind of familiar with this. I think it just goes to show that there's a mechanism going on. It's hard because you're in this position where when you see price action like this, your natural inclination, or maybe mine, not everybody's, but mine, well, there's two actually. It's either to chase it or it's to fade it, right? And both can be disastrous and both can be amazing, right? And so the art of the game is deciding the timing on it. And, as we've kind of said, and I guess we've been wrong, but it's okay to just sit on the sidelines and wait also. It is what it is, this is
okay.
happening.
So this is a natural segue to what I want to talk about. If you are sitting on the sidelines with respect to the semi, and I'm guilty as charged here, this is a log chart of the SMH since late 23, right? Because the regular chart just looks a bit crazy, but ultimately we've hit the sort of parabola phase with this SMH chart. Now, to my mind, the one thing that this chart is not going to do is correct in time, right? We're either carrying on climbing at the same rate of change now, or we're going to get some kind of correction. So what do you do about that? I have a playbook which I used in this 24 period, right? Just ahead of, you remember the first really big Jensen beat and raise in May of 24. Do you remember that one? It was when I coined the phrase the Highlander. This was in Q1 24. Love it. There can be only one. And I was feeling a bit like I am now. Christ, there's a massive party going on, and I'm not part of it. And so I went back to one of my favorite playbooks, which is the calendar strangle, right? And this is what I sent to my team last night. The idea is that you buy June calls out of the money. These are about 38 delta calls, right? And simultaneously buy the same number of September out of the money puts, right? And this is a trade that you can't just set and forget. You dynamically manage, right? This allows me to get onto the side of the bulls and even cheer it on near term rather than sneer at it, right? And I get to the trading strategy is to continue rolling up those June calls as you participate, and the goal is to earn that premium back on those September puts. So the strategy is to get into a free position in September out of the money puts by the end of the process. So there isn't much convexity on those out of the money calls, right? There's not a massive payoff there, but all you're looking to do is to defray the costs paid for those puts, and then you're in a free put position until through the back end of the summer, right? And you can just sit back and wait with a big smile on your face, right? And that's how I'm personally managing this one. And I think there's a good chance that you could end up rolling those calls a couple of times. After a couple of weeks, the daily time decay is going to get quite extreme. So you might push out into the July weeklies, and once they start getting listed, right? But if you can roll that call leg up 2 or 3 times, you'll have paid for those puts after the first 2 rolls. Anyway, that's kind of what I like as a trade.
Yeah, I mean, look, I like that. I like the idea. I think that also people need to remember, just as from a human perspective, like today, I had a guy that Squirrel and I know, who's a partner of mine, calling me, and I created this thing called the Workflow OS. It's still in beta, but as a way to give you ability to go from your idea to converting how these things think, and then creating workflows and then chains. And really there's an optimization process even within the current transformer models. But then you're talking about what we're doing at Second Brain and other people are doing, putting a layer on top of it. Then there's other models that are coming around, like SSMs and hybrids. And it's just, I think we're at the peak bonanza right now. I just think that agents blowing tokens, token maxing, whatever you want to call it, then Goldman writing this and this stuff, and then the stocks doing this. And we're just in one of those weird periods where humans are all just acting like lemmings and it's going bananas. And there's so many flows, and there's so many people don't really understand what's going on at a mechanical level, at an engineering level, that it's just following the high frequency data they see. And so approaching it with a rational head, very hard, but what Rupert just talked about is one way to do it. Sitting in your hands is one way to do it. Listening to us, and I'm sure when I'm very excited, I will tell you. But it seems to me it's going to be a shoot 'em in the back situation, doesn't it, Rupert?
I think so. Well, this is a complete change of direction here, because this is a shoot 'em in the back. Now, we've talked about the lack of breadth in the market right now. There are parts of consumer that are really sucking wind last night. I mean, so we had Wingstop and Shake Shack earnings last week. Shake Shack was attempting to blame the weather for their same-store sales sort of miss. But the consumer is deteriorating fast. This is a strategy that's been, there was a moment in November where these consumer student names started to take off to the top side again quickly. But if you look at all of these charts now, they are firmly in shoot them in the back territory, and they're still really, really expensive. I mean, this is your former bailiwick at Fidelity, the consumer space. Benny, is it you staying close to any of these names?
I do some. I think that basically it's kind of what Cubby said when he came on our show in March, which is he doesn't want much exposure to the middle GDP exposed stuff, and I think that's right. The reality is if costs are going up, and that means real estate goes up, and there's just pressures, and food, we talked about it with Nico, and you wrote some notes about the eggs. Just gonna be hard to have incomes grow faster than costs, which means those guys are going to get squeezed. And then with the distribution of income getting narrower, the distribution of gains in the stock market getting narrower, you just have instead of a K economy, you have what I call a gamma economy. If you look at the beta, the Greek sign gamma, it's just like this, like the top, and then everybody else, right? And And you know, it's just hard to be in the middle for that, right? And a lot of the businesses you just talked about were kind of catering towards the masses. And I don't know, it's a crazy situation right now. And I'm with you that I wouldn't want to be, you know, other than when they're like when we had Jeff Mackey at our first guest show in November and consumer was completely bombed out. Yeah. When stuff's completely bombed out, or these names get a bid, whether
that was the period. That was the period of time I was referring to, because I'd been short these restaurant names from midsummer, right? And that had been a great trade, but you know, I had a massive sort of pullback in my face over that brief period of maybe the consumer's going to be okay, and Christmas sales, holiday sales looking fine, and you know, maybe this is the soft landing thing. That was the moment. But I'm saying that the vectors come straight back to where we were before then now. And, you know, I mean, a couple of the names that I'm still sure, like Arbor is reporting on the 19th. And they moved in response to the Shake Shack and Wingstop notes, misses last week. So I'm not sure that there's any alpha there. I think they're more likely to surprise to the upside now. I think the worst case is being baked in last week. We're at the half-hour mark, but we have a celebration, don't we, Benny? By the way, in the show notes, there are a couple of extra things that I haven't managed to get to yet, because Benny likes to talk about AI. But thank you for being.
There it is, just a little zinger.
Thank you for being with us, everyone.
Thanks. It's been fun. Well, hopefully the next 50 will be even better. And we will see you on Thursday. We have Larry McDonald coming on. Larry got called in sick last time, but we got him on this week. So we'll have
coming Wednesday, isn't he? Are we doing it Wednesday? Are we doing it?
We're recording Wednesday, but we'll put it out normal time on Thursday.
Okay, sounds good.
And it will be Thursday for you anyway, since you're in Hong Kong.
I know, but I'm so civilized that I always talk your time zone, because Americans aren't very good at clocks.
That's true. That's true. Although you see my international clock in the back, that makes it simpler.
Well done. It doesn't seem to help you that much. Anyway, Benny and the Squirrel out. Take care, guys. Good luck out.
We're out.